Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover several questions from Chapter 2, Gross Income, Inclusions, and Exclusions. So as we learned in this chapter, gross income, the definition is essentially all income from whatever source derived. So that's perhaps the most well-known definition in the tax law. So under this definition, unless there's a specific exception in the Internal Revenue Code by law, the U.S. government considers all income taxable. So in this example, this first problem is asking us to indicate whether each of the items listed below should be included in gross income or excluded from gross income in 2023. So for this first example, we have prizes and awards. So prizes and awards are considered income. So this would be included. Embezzled funds would also be included. So one key thing to keep in mind, embezzled funds, that's basically like, where individuals are committing fraud, they're stealing and things of that nature. So even though the money is obtained illegally, the IRS still considers this to be income and it still needs to be reported. Next, we have child support payments. Child support payments based on the 2023 exclusion from gross income list, child support payments are excluded for purposes of gross income. Alimony received from a 2021 divorce. So there have been a lot of changes to the tax code. And one of the biggest changes was the Tax Cuts and Jobs Act, also referred to as TCJA. So with this change, essentially any alimony payments that were made after this act, they are not reported as income for the recipient and they are not deductible for the payer. So therefore, alimony received from a 2021 divorce is excluded. Any pension payments received, those are included for purposes of taxable income. Any inheritances received. So inheritances received, these are essentially, someone passed away and they left you something. It would be included in income when you sell it. However, when you inherit it, it is excluded for tax purposes. Welfare payments are not a part of income. Any bequests are basically just like, inheritances. If a person leaves cash, jewelry, any item, so it's similar to an inheritance or a gift, it's excluded. Any reasonable housing allowance that's provided to a clergy tax law is essentially like a niche. So clergy, and whenever they receive reasonable housing allowances, this is considered excluded. Next, we have what's called royalties. So this is basically, let's say you create a work of art, whether it is artwork, if you compose music. So after you've created it, if it still generates income, then you receive what's called royalties. That is included, in income. Life insurance proceeds that are paid at death, these are considered excluded. Hobby income is essentially considered included in income. Hobby, that's basically, let's say an individual, they start a business. There's what's called a hobby loss rule. And that essentially determines that if a person starts a business and they have a loss for 3 out of the past 5 years, then the IRS basically might determine that it's not actually a business. Instead, it is a hobby. And the reason why there's this rule is because oftentimes persons, they will have a business and intentionally have losses because they want to reduce their taxable income. Next, we have legal settlements related to a physical injury. These are considered excluded for purposes of tax law. Any partnership income that's allocated. So if there's a partner in a business and they receive Form 1065K1, that income is passed through to the individual partner or partners rather, and reported on their tax return. Casualty insurance proceeds would be considered excluded. So this is like, let's say, there's natural disasters that take place, and if a person has homeowners insurance or casualty insurance, the proceeds that they receive because of the casualty is not considered income. GI Bill benefits, this is for those that are part of the military. GI Bill benefits, they can use these for education for themselves, their spouses, and their dependents. It's excluded. Scholarships for tuition and fees are excluded. However, if an individual receives a scholarship from room and board, it might be included in income. Next, we have qualified Medicare waiver payments. These are considered excluded, and any gifts received are considered excluded. So as you go through this problem, you can select the ebook, select the learning objective 1. And once you click on that link, it will take you to the learning objective 2.1. Here it discusses the definition of gross income. And then from there, you will essentially see that there's a partial list of gross income inclusions in addition to 2023 exclusions from gross income with a few examples. So this brings us to the next question. Here we see it's asking, based on Virginia's W-2 form, determine the following amounts. So here we have a W-2 from Luminary Dollars, Inc. that was issued to Virginia Nova. So this is what a W-2 looks like. So a W-2, this is essentially a wage and income form that is provided to employees. So whenever you are an employee, you would receive this form W-2. It is issued annually, and it basically reports the income that you have earned during the year. So box 1, that reflects the taxable wages. Box 2 represents the federal income taxes that have been withheld during the year. Box 3 represents the Social Security wages that have been earned during the year. So as an employee, 6.2% is subjected to Social Security taxes, and our Medicare wages are subjected to 1.45%. So again, the primary form of reporting wages to an employee is through the form W-2. So in this case, the first part of the problem is asking taxable wages to report on line 1A of form 1040 is mentioned is box 1. So on box 1 of form W-2, again, this is where employers, they should report taxable wages, taxable salary, taxable bonuses, awards, commissions, etc. And basically any other type of taxable compensation needs to be reported in box 1. So in most cases, box 1 is reported directly on line 1 of form 1040. So if a taxpayer receives more than one form W-2, or they're filing a tax return jointly with their spouse, and their spouse has their own form W-2, then the amounts in box 1, they're basically combined and then entered on line 1, form 1040. So based on this information, the wages, tips, and other compensation, the taxable amount is $52,250. The next B asks us the federal tax payments withheld to report on line 25A of form 1040. So based on box 2, we see that the federal income taxes withheld is $3,398. So box 2 of form W-2, it reports the amount of federal income taxes that have been withheld from the taxpayer's wages by the employer for the year. These taxes have been withheld by the employer and remitted to the federal government on behalf of the employee, and it's entered on line 17 of the form 1040. So we'll enter it here on line 25A rather. So 3,398. The federal tax payments to be reported on line 25A of form 1040. C asks the amount that Virginia contributed to her company's 401k. So here we see that the taxable amount on line 1 is $52,250. However, we see that there's a difference between boxes 3 and boxes 5. Boxes 3 and 5 show $55,000. So there's a difference. So if we, examine the W-2 we see on line 12A, there's a code D. So box 12A is basically, used for reporting a variety of different forms of compensation, such as maybe there's reimbursed parking, there's healthcare premiums, other fringe benefits. So there's several lines. There's 12A, 12B, 12C, 12D, etc. So in this case, code D, this represents elective deferrals into 401k plans, and DD represents, healthcare premiums paid by the employer. So this code D, this represents deferred compensation, elective deferrals into a 401k. So what this basically means is that Luminary Dollars Inc., they have a retirement plan, and Virginia decided that she is going to invest $2,750 pre-tax. So therefore, she's not paying taxes on these amounts. Now, hence, she earned $55,000, but because she contributed $2,750, therefore, this reduces her taxable income. And whenever it is that she decides to withdraw the funds, then this 2,750 and the increases in value, then it would be subjected to taxation. So the correct answer to C, the amount that Virginia contributed to her company's 401k, will be reflected in line 12A, code D. And then lastly, it asks the amount to report as state income taxes paid if Virginia itemizes her deductions. Boxes 15 through 20 reports all of the state information. So we see that 15 shows the state VA, Virginia, the employer's state ID number. Box 16 shows the taxable state wages, and box 17 shows the state income taxes of $1,780. So again, once you are preparing a tax return, you input this information into the tax software, and it basically transfers it to the necessary sections in the tax return. But again, you want to be able to understand, once you are inputting these forms, what impact it has on a tax return overall. So this brings us to the next question. It says, Christy and John Harris Thomas received the following 1099 INTs during 2023. So it's asking us to prepare Schedule B. So one key thing to keep in mind with Schedule B will only be reported if the interest, income, and dividends exceed $1,500. So let's say you have a client and their investment income is maybe only $500 or $1,000. You'll input the 1099 INT and the 1099 DIV information, but Schedule B will not generate unless it is forced. And again, the reason being is that the threshold for this Schedule B to be generated is that the total interest and ordinary dividends exceeds $1,500. So here we look at this example. And the first section deals with interest. So we scroll up and we look at this 1099. So we have a 1099 INT, as we see here. And we see that there's interest of $1,356 from Lake Osborne Savings and Loan. There's, no other information in the boxes. Sometimes box 2, 3, 4, etc. might be completed. But for the most part, in the 1099 INT, box 1 represents the taxable interest. So we scroll down and report the interest from Lake Osborne Savings and Loan. So the problem essentially, wants us to round the numbers. So it's $1,356. And then from there, we just finished with this 1099 INT. In addition, we have a combined 1099. So whenever an individual has a brokerage account, they generally issue what's called a 1099 composite. So what this basically means is that with the brokerage company, it basically, reports any 1099 interest, any 1099 dividend, any 1099 information just in case there was a sale of stocks and things of that nature. So it reports all of it in one package versus sending individual, forms per client. So that's why we have this 2023 combined forms 1099. So here we see for Fire Truck Investments, there's interest income of $358. So we scroll down, Fire Truck Investments, $358. And we also see that on box 3, there's interest on U.S. savings bonds and treasury obligations. So Fire Truck Investments for the U.S. Treasury bills, these are considered taxable. Tax-exempt interest, on the other hand, are not considered taxable. So in a future problem in the same assignment, we will see how this is reported on Form 1040. But at this juncture, it's just asking us to prepare Schedule B. But in a problem soon, we will see how it is reported on Form 1040. So we account for this $800 for the fire truck investments on the U.S. Treasury bills. So we scroll down. Fire truck investments for the U.S. Treasury bills, the T-bills, which is abbreviated as 800. And then from there, we also need to account for, it says here, according to John and Christie's records, they purchased U.S. Treasury bonds between interest payments and paid accrued interest of $107.40 to the seller. So based on this information, we need to account for the accrued interest. So in this case, we account for the accrued interest, which has a decrease in impact. So therefore, the $107, as it points out in this sentence, needs to reduce the amount of interest. So we put a minus 107. And from there, we essentially calculate what is the total interest. So if we get our calculator, it's calculated as follows: 1,356 plus 358 plus 800 gives us 2,514. And from there, we subtract the accrued discount of 107. So therefore, if we add the amounts on lines 1, that gives us 2,407. And then for line 4, it asks us to subtract line 3 from line 2. So in this example, line 3 is 0. So 2,407 minus 0 is the same thing, 2,407. So with this problem, there were, no dividends for us to report. Part 3 was already completed. So again, as it relates to the 1099s, INT and 1099 DIV, if it exceeds $1,500, it will be reported on Schedule B of Form 1040. This brings us to our next problem. And here it states, George and Talia are married and are living together in California. Their income is as follows. George has a salary of $40,000. Talia has a salary of $30,000. George has dividends from his property of $5,000. Talia received dividends from her property of $3,000. And then there's interest from community property of $4,000. All right. So whenever a married couple files a separate income tax return, there's problems that can arise, right? So income that's derived from property that's held by a married couple, whether it's jointly or it's separately, this also includes wages and other income that's earned by a husband and a wife. it needs to be allocated between the spouses, right? And the reason being is because state law becomes important when they have to make this allocation. It doesn't apply at the federal level, but depending on the state that they live in, they have what's called a community property system of marital law. So the law in 9 states is based on this marital law. So in these 9 states, the property rights of married couples, they differ from the property rights of married couples that remain in the other what's called common law states. So the 9 states that are community properties are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. So in Alaska, spouses, they may elect to treat it as community income. So, they have that option if they want. So under this community property system, all property is deemed to be either separate property or it's deemed to be what's called community property. So separate property, that includes any property that was acquired by a spouse before they were married or received after marriage, as maybe it was a gift or an inheritance. And all other property that's owned by a married couple, it's presumed to be community property. So for federal income tax purposes, each spouse is basically automatically taxed on 1/2 of income from the community property, right? So the tax treatment of income, it's basically depending on the state of residence. So in order to get a better understanding of this property, we have a spreadsheet that will give us a better understanding of how this will be accounted for. All right, so here in this example, it's asking us if they file a separate return. And again, this is saying that they live in California. So in California, it would essentially be split as follows. So George's salary would be split 50% with Talia. Talia's salary would be split 50%. The dividends that are related to George's property are essentially not going to be counted for community property income. Talia's dividends from her property would be accounted 100%. And then interest, which is considered community property, is going to be split 50-50. So the calculation would be as follows. 40,000 multiplied by 50%. The 30,000 of Talia's salary multiplied by 50%. None of George's dividends would be considered. For Talia, the full amount of the dividends will be included. And for the interest for the community property, it would be split in 50%. So under California law, Talia's income would be 50% of George's salary, 50% of her salary, 0% of George's dividends, 100% of dividends that pertain to her property, and 50% of the interest, which is considered community property. So under California, $40,000 would be considered income. All right, and now the property is asking us about Texas. So in certain states, again, there's 9 states that's based on a community property system of marital law. But in states like Idaho, Louisiana, Texas, and Wisconsin, income from separate property produces community income. So thus, it's basically just as though each spouse is taxed on 1/2 of the separate property. So in such case, now we scroll over and we look at Texas's rules. So under Texas rules, everything is split 50%. Salary splits 50%. The property for George is split 50%. I'll actually make this bigger. The property for George is split 50%. The dividends for Talia is also split 50%. as well as the interest in the community property. So we see the difference here in California. The property is split separately, but under Texas's rules, everything is split 50-50. So under Texas rules, Talia's income would be $41,000. All right, so again, this is definitely why people need to consider when they are planning to move to a state. And if they're married, obviously there's an impact. So some states are common law, whereas some states are community property for marital law. And it obviously has an impact if the individuals, the married couple, decides they want to file separately. So this brings us back to the question again, 40,000 if they lived in California, and then 41,000 if they lived in Texas. So here we have this multiple choice question, and it asks us about the nature of gross income. So as we know, the definition of gross income in income tax law, is it all cash payments received for goods provided and services performed? No, this is incorrect. All income from whatever source derived. So this appears correct, but we'll go through all of the answer choices. All items specifically listed as income in the tax law. Unfortunately, no, that is not a way to get away from reporting taxes, because unless it is specifically listed as excluded, everything is basically reported in income. And lastly, all income reported from whatever source, or sorry, all income from whatever source derived, unless the income is earned illegally, that is not true. So again, if someone embezzles funds, it should be reported. If someone sells drugs, it should be reported. So the correct answer is B. All income from whatever source derived, whether it is legally earned or illegally earned, it must be reported. So here we have Social Security benefits. So it's asking for 2023, the maximum percentage of Social Security benefits that could be included in a taxpayer's gross income is. So to get a better understanding, we are going to go to the ebook Learning Objective 16, which discusses Social Security benefits. So for Learning Objective 216, it's to apply the rules governing inclusion of Social Security benefits in gross income. So some taxpayers, they may exclude all of their Social Security benefits but from gross income. However, most middle income and upper income Social Security recipients, they may, keyword is may, have to include up to 85% of their benefits in gross income. So it's either the Social Security benefits are not taxable at all, it's taxed at 50%, or the maximum 85%. So the formula to determine taxable Social Security income is based on modified adjusted gross income. So in order to calculate our adjusted gross income, it is essentially gross income as we determine income from all sources, whatever source derived, minus deductions. That gives us our adjusted gross income. So generally, the modified gross income, or the modified adjusted gross income rather, is the taxpayer's adjusted gross income without considering Social Security benefits plus any tax-free income. And then in certain instances, the taxpayer will also add back any unusual items, such as any foreign earned income exclusion, any employer provided adoption benefits, or interest on educational loans. So if the modified adjusted gross income plus 50%, 1/2 of Social Security benefits is less than the base amount, then the benefits are excluded for income. So just keep in mind, as it says here, it shows here, base amounts are not adjusted for inflation. So for a married filing joint couple, the base amount is $32,000. For a married taxpayer that did not live apart for the entire year and is filing separate returns, the base amount is $0. So basically, once the individual's provisional income is more than $0, then it's taxable. For all other payers, the base amount is $25,000. So based on this information, we have enough to answer this question. For 2023, the maximum percentage of Social Security benefits is 85%. So this brings us to this question, same learning objective 216. It says a 68-year-old taxpayer has $20,000 in Social Security income and $100,000 in tax-free municipal income. So as we just discussed, here it states that the modified adjusted gross income is the adjusted gross income plus any tax-free interest income. So municipal bonds are considered tax-free interest income, investment income. So in this case, does the municipal bond income affect the amount of Social Security? And then it's asking tax-free municipal bond income. Does it have no effect? Is it added to AGI or is it deducted? So based on the tax rules, the municipal tax-free bond income is added to AGI to determine the amount of taxable Social Security benefits. For Part B, it asks a 68-year-old taxpayer has $20,000 of Social Security income and has no other taxable or tax-free income. How much of the Social Security income must the taxpayer include in taxable income? So if their only income is Social Security, and here it lets us know that the individual is single, we know that the base amount for a single individual is $25,000. Since the modified adjusted gross income plus 50%, which is often referred to as the provisional income, is less than $25,000, in such case, $0 is going to be included for this taxpayer. So for C, it asks, what is the maximum percentage of Social Security that the taxpayer might be required to include in taxable income? So it states a 68-year-old taxpayer has $20,000 in Social Security income and has significant other taxable retirement income. So based on this information, once the individual's base exceeds $25,000, it doesn't say if they are married, but what it does say is that they have significant other taxable retirement income. The maximum percentage that will be taxable is 85%. So this brings us to our next question. And it says interest income and dividend income. So this deals with learning objectives 2.9 and 210. So we have this form 1099 DIV from Kentucky East Corporation. So we see total ordinary dividends. We see qualified dividends of 720. And then we also have total capital gains distribution, which we will go into more detail in a few. Then we also see that there's a 2023 combined Form 1099, a composite from Fire Truck Investments. We have a 1099 DIV, and we also have a 1099 INT. Then it provides a detail that was provided by Fire Truck Investments on how the total dividends were calculated and how the total interest was calculated. So for this problem, it's a multi-part problem. For A, it's asking, assume that the colonel's final joint tax return complete Schedule B of Form 1040. And then it also asks us a few questions. What amounts are reported on Form 1040 for lines 2A, 2B? What amounts are reported on lines 3A and 3B for Form 1040? And are there any other amounts reported on Connell's federal income tax return. So it's asking about the capital gain dividend. So in this example, we start to consider the interest. So if we look at the Schedule B, the interest is always considered first. So if we look at the interest, we know that for Kentucky East Corporation, they only issued a 1099 dividend. So our interest is reflected from Friar Truck Investments. They gave us this composite. So it shows us that on box 1, we have interest of 2,000. Box 3, we have interest of 200. And box 8, we have tax exempt interest of $550. So in this example, we essentially need to account for the various types of investment. But one key thing to keep in mind, when we are reporting and accounting for interest in particular, publication 550 essentially states that if we receive it from multiple sources, so as we see here, we have interest from Porcine Bank, River Bank, a U.S. Treasury bond, and things of that nature, we essentially just need to report the total amount from the brokerage company. So just keep that in mind. So if we receive a Form 1099 INT or a Form 1099 OID from a brokerage firm, we list the brokerage firm as the payer, not the individual bank. So in such case, we list the Friar Truck Investments for the total amount. But one key thing to keep in mind is that municipal interest is not considered taxable. However, the interest on the U.S. savings bond and treasury obligations are considered taxable. So we can look at it this way. We can add box 1 plus box 3. So 2,000 plus 200 gives us 2,200. Or we could even look at the details. The details show 2,750. But we know that the municipal bond interest is considered tax exempt. So we can subtract the total interest of 2,750 minus the 550. So therefore, the Friar Truck Investments is 2,200. And again, how do we calculate that? The total interest minus the municipal interest, which is tax exempt. Or we could look at the 1099 INT and we would add box 1 interest income of 2,000 plus box 3 interest income of 200, and that gives us 2,200. All right, so we scroll down to this part of the problem where it is asking us what amounts are reported on lines 2A and 2B of Form 1040. So to get a better understanding, we look at Form 1040 for 2023. So as we look at this Form 1040, we see that line 2A deals with tax exempt interest and line 2B deals with taxable interest. So based on this information, as we just calculated, we see that the taxable income in this case is 2,200. So we add the amounts on lines 1, which gives us 2,200. Line 4 says to subtract line 3 from line 2, and then we enter the result here and on Form 1040 or 1040 SR line 2B. So this amount will be transferred to Form 1040 line 2B. So we know that this amount is going to be 2,200. And line 2A, as we see here, represents the tax exempt interest. So this represents the municipal bond interest, which we see on the 1099 INT is the $550. Next, we move on to C, and we move on to part 2 of the Schedule B. So Schedule B is where we need to report the ordinary dividends. So here we received 2 dividends. We received dividends from Kentucky East Corporation. And then in addition, we received dividends from Fryer Truck Investments. So we'll start off with Fryer Truck Investments. And as we look at our Fryer Truck Investments, on this line, we are essentially reporting the ordinary dividend. So again, we look here on the form and it wants us to report the ordinary dividends. So here we refer to our ordinary dividends, and the amount is already calculated as 5,850. And then from there, we consider the Kentucky East. And on the 1099 DIV, it shows us total ordinary dividends of $1,000. All right, so next, line 6 asks us to add the amounts on line 5. And then from there, we enter the total here and on form 1040 or 1040 SR line 3B. So in this case, our fire truck investments is 5,850. And our Kentucky East ordinary dividends is $1,000. So if we add the two, the total is 6,850. So we have the answer for our line 3B as it says here. Enter the total here and on form 1040 line 3B. So we know the answer here will be 6,850. And then the next portion of the problem is asking us about line 3A. So if we refer to form 1040, on line 3A, we see our qualified dividends. So one of the reasons why it is very important for us to distinguish, between what are ordinary dividends and qualified dividends is because dividends or ordinary dividends, it's, one of the most common types of corporate distributions. So dividends are essentially our type of distribution that's paid to a shareholder by a corporation. So for those who invest in a corporation and they receive ownership via stock, they receive dividends. So ordinary dividends, again, it's one of the common types of corporate distributions. They're paid from the earnings and profits of a corporation. But to provide tax relief for individuals who receive corporate dividends, the tax rate on qualifying dividends is either 0, 15, or 20%, depending on the taxpayer's taxable income. So ordinary dividends are subjected to a more preferential tax rate. So that's why it is very important that when you're reporting Form 1099 DIV, you want to ensure that you are importing boxes 1 and boxes 2 into the system correctly as it is reported on the 1099 form. So in order for us to determine the amounts that need to be input on 3A, it will be calculated as follows. We see the first 1099 DIV, and it lets us know there's qualified dividends of $720. So the 1099 DIV from Kentucky East shows qualified dividends of $720. And then the 1099 DIV from Fryer Truck Investments is $4,850. So we add that amount. So therefore, on box 3A, the qualified dividends will be $5,570. And the great thing is that when you input this information into the tax software would automatically generate Schedule B, and then it would transfer the amounts to the appropriate lines on the Form 1040. D asks, are any other amounts reportable on the colonel's federal income tax return? So on the Form 1099-D, we also see a capital gain. So maybe there was a sale of stock And with the sale of stock, there's what's called a capital gain. And the capital gain in this case is reported as $170. So we report this amount on line 7 of Form 1040D line 7 of Form 1040 or Schedule D. And let's see if we can see an example. All right, it's not showing us a clear example for 2023. But again, it would be reported as it shows here as capital gain. And again, it is taxed at a preferential rate, much like the qualified dividend. So again, it's very important to be able to understand the nuances behind these forms. Please keep in mind, for those of you that want to venture into taxation, if a client has 1099 interest and 1099 dividend income, if it is less than $1,500, the Schedule B will not automatically generate. The threshold is $1,500. So this brings us to the next question. And it asks, the amount in box 1 of Form W-2 for taxable wages will always equal the amount in box 3 of Form W-2 for Social Security wages. This is false. So as we've seen in the previous example, sometimes there are differences, and the difference might be due to deferred compensation and things of that nature. So this is false. Box 1, boxes 3, and box 5 might have differences, and it is generally reflected in boxes 12A through 12D on the Form 1040. In addition, it might be also reflected in box 14. Next question. In some cases, Social Security benefits may be partially taxable. So this is true. As mentioned, Social Security benefits might not be taxable at all, 0%. It might be taxed at 50%, or it might be taxed at the maximum of 85%. This brings us to our last question. For the current year, the maximum percentage of Social Security benefits that might be included in a taxpayer's gross income is 85%. So in this chapter, we covered the gross income, inclusions and exclusions. Again, the definition of gross income is all income from whatever source derived. And again, unless it is specifically included in tax law, then you can essentially consider all income fair game unless there is a specific provision that determines that income should be excluded for tax purposes.